Ladies and gentlemen, guess what? Stick around, because we are moving very swiftly onto our next session just in a few moments' time. But again, stay with us right here in the Da Vinci room for more intimate conversations and insights here at Proof of Talk 2025.
Mic check. All right, thank you guys so much for that. Kathy is a hard act to follow, there's no doubt about it. But we have somebody who is capable of it. Sergey Nazarov of Chainlink is on the line with us. Sergey, I hear that you're going to be able to hear me. Are we going to be able to see you? Mic check on Sergey. I think he's going to be tuning in from New York. Hey, there he is. Sergey, we can see you, but I understand you're not going to be able to see me making funny faces at you, unfortunately. Oh, okay, cool. Hey, thank you so much for joining us. We have an opportunity to talk a little bit about stablecoins. You and I have been talking about this a lot lately. But for those that aren't in the room right now, we're going to kind of start off with a little bit more of a regulatory look. Chainlink is somewhat rarely placed as sort of in the middle ground there between traditional finance and decentralized systems. So you have a broad insight into where those points of contact are. Could you give us just kind of like a brief little overview of the state of play? Like, are there one or two most important regions that we should be paying attention to regarding the future of stablecoins and who are setting those trends?
Sure. So Asia has been far ahead in regulatory clarity relative to the rest of the world, namely Singapore with the Monetary Authority of Singapore and Hong Kong with the Hong Kong Monetary Authority. For example, yesterday we released a report with Visa that shows how you can do cross-border transactions in the Hong Kong Monetary Authority's framework, and that'll include compliance data, valuation data, and stablecoin payments across multiple currencies, across multiple jurisdictions. The next jurisdiction that has made the most progress, I would say, is Dubai and the Emirates. Dubai and the Emirates recently approved many of their large commercial banks to start looking at how to issue their own stablecoins. So that is a big step forward in terms of those banks being able to issue their own dedicated stablecoins. And the regulators in Dubai and Abu Dhabi are both very progressive and pro-crypto and forward-looking on how stablecoin regulation and digital asset regulation in general would work. And now in third place, it's the United States, because the United States has really ramped up their kind of adoption of stablecoin ideas and how to approach making those. And then
I have to admit, I was a little surprised by the first two there. Are they minting stable dollars, or are they exploring other currencies? Can we get just a quick little snapshot right now of the breakdown of stable coins that are dollar backed and where you might see any trends going in the future there?
Well, the funny thing about it is that most of the geographies that I've mentioned are largely dollar backed at the lowest level of at the most fundamental level of their financial system. So, for example, the HKMA's EHKD, so Hong Kong dollar, the Hong Kong dollar is largely backed by the U.S. dollar reserves and pegged in a certain sense to U.S. dollar value. Similarly, in Singapore, the second place that I mentioned in Asia is also the Singapore dollar is heavily backed by the U.S. dollar. So, because those two financial systems are so tied to the U.S. dollar, even if you have something like the Hong Kong dollar or a stablecoin version of the Singapore dollar, it'll fundamentally be backed by the US dollar because the current traditional version of the Singapore dollar and the Hong Kong dollar are so tied to the US dollar. So that's the first thing that'll be quite important to understand about what will end up actually happening. And then there are fundamentally two approaches to stablecoins. One is to have an ecosystem of stablecoin issuers, such as private banks or fintechs, such as Circle or Tether or other fintechs that decide to issue stablecoins who aren't regulated as banks and aren't banks. And then the other approach is to issue your own stablecoin as a government. The Hong Kong dollar is an interesting direction from that point of view. But most central banks now, and we work with many central banks at this point, providing them with compliance technology, connectivity across chains, data technology, all the things they need to make their blockchain ecosystems and digital asset economies work. Most of our interactions with central banks have found them wanting to build that ecosystem more so than get directly involved in issuing their own stablecoin, because that is often a more technical undertaking that requires a large technical investment. And that's not usually what central banks want to do. Central banks usually want to manage an economy or an ecosystem of commercial banks and asset managers and financial market infrastructures that work together to make that economic system and economic ecosystem work.
I do want to talk a little bit more about some of the more traditional stable coins that are emerging and evolving. But if we could take a pause there on what you were just talking about, your work with central banks. You did talk a little bit about the difference between a corporate issued stable coin and a central bank issued stable coin from the financial perspective. But from a user perspective, are there any differences that we should be paying attention to for the sort of like fundamental implications of using a CBDC versus a stablecoin?
Yeah, so with CBDCs, your counterparty will be the central bank, which is the lowest risk counterparty you can have. If you have a privately issued stablecoin by a bank, your counterparty and your counterparty risk is the bank. And if the stablecoin is issued by a fintech, then your counterparty is a lightly or unregulated fintech. And counterparty risk is not something that people outside of traditional financial capital markets usually think about, because they don't usually deal with the types of amounts or failure scenarios. But in the crypto world, counterparty risk is actually a very common problem. You know, Terra, FTX, 3 Arrows Capital, that's a counterparty that failed. In the traditional banking sector, in the US, for example, it would be Silicon Valley Bank. In Europe, it would be the payment system Wirecard that failed. So counterparty risk is a very real consideration. And the most fundamental difference, I think, is that with the central bank digital currency, your counterparty is the government, which is the lowest risk counterparty you could have, since you're actually exposed to that risk anyway, since they could do all kinds of things in relation to the currency. And the other ones are progressively more counterparty risk, depending on their solvency, their reporting requirements, their quality of how they manage reserves, their quality of proving the reserves through things like proof of reserves, which is a technology we're heavily implementing with many commercial banks and various stable coins to prove that the reserves are actually there on a real-time basis. So there are technical ways to mitigate the counterparty risk, such as proof of reserves, that some are implementing. And then the second big nuance about central bank digital currency is the concept of government control, such that governments could control bank accounts or could control assets or could freeze assets in ways that are antithetical to our industry's fundamental kind of principles and are not aligned with this kind of libertarian notion of a sovereign individual and free controls of one's assets. I think the only thing I really have to say about that is I'm not sure people understand just how little control they have right now. Yeah. They have an extremely low level of control over their assets in every banking system. And so the incremental difference between the level of control you have in the current banking system and the level of control you'd have in a CBDC system, it's not clear to me what the fundamental difference would be. And then the one thing you could do with a CBDC that you can't do with the current traditional bank account is you can wrap a CBDC. So you can provide a CBDC as collateral into some wrapping system. And then that wrapping system could give you a measure of control over that CBDC that you can't have over a traditional bank account. So the benefits of reduced counterparty risks are in fact quite large. And the idea that you will lose some extremely valuable but currently existent version of personal control over your assets or bank account is something, after looking deeply into how bank accounts work and looking deeply at how CBDCs work and looking deeply at how wrapped versions of CBDCs work, is something I personally don't understand exactly what what's getting lost there. But maybe I'll look into it more. Someone will explain it to me.
That's so helpful, Sergey. Thank you. There has been sort of in recent history. Obviously, there is only recent history with a lot of these questions. Sort of a binary: CBDCs and stablecoins. Stablecoins issued by companies, CBDCs theoretically issued by central banks, though theoretically is operative. There's recently been what I might categorize as a third option. I'm not sure it's been named yet, but state-issued currencies, where Wyoming is looking into this, and bank-issued currencies, stable coins, I should say. Notably here in Europe, specifically here in France, Société Générale recently did a euro-backed stable coin. Could you talk a little bit about whether or not it means anything that a bank is issuing a stable coin, and what it might mean for the socioeconomic global flow of value as the rise in euro might take over some of the US dollar share? Two questions there. I apologize. First one, does it mean anything? Does a stablecoin being issued by a bank sort of change the relationship of that stablecoin with its user?
Yeah, so your idea about local governments or banks issuing stablecoins is the same as what I mentioned before, where your counterparty will not be the government with a central bank digital currency. It'll be that local government, or it'll be the bank, or it'll be a fintech like Circle or Tether. And so that's just different. That's a spectrum of counterparty risk, and that spectrum of counterparty risk by those issuers can be reduced by proving things to you, like reserves. So if a fintech proves to you that their reserves are always there, or the fintech has a custodian relationship with a top tier, too big to fail global bank, like Bank of New York Mellon or Cantor Fitzgerald or something, then you're actually held up by that custodian bank and the proof that you're getting from the fintech through proof of reserves, which could give you more assurance than whatever a local government might do, unless they also have proof of reserves and a good custodian. So all of those different issuers that you said, for me, will all be in a single framework of stable coins. The difference will be, what is their counterparty risk? Who is the custodian of the real world cash or treasuries? What is the yield sharing that they conduct with you? Do they give you the yield, or do they keep the yield? And how do they prove to you that those assets exist in a real-time basis through something like proof of reserves or proof of composition or other proof of schemes that assure you that those assets backing your coin are there?
And I do want to talk a little bit about the intro of the euro dynamic, but let's pause there and talk a little bit about this proof of reserves concept. It seems like that's sort of fundamentally tied to this question of trust and counterparty risk. Where does proof of reserve come from, and how do we sort of remove the element of trust from that equation?
Sure. So proof of reserves is the automating proving of reserves of the assets underlying a token. And then there's something called proof of composition, and then proof of solvency, which is a much higher level of proof. All of this is basically meant to replace annual audits or quarterly audits with real-time audits. So the way to think about proof of reserve, proof of composition, proof of solvency is that instead of a person evaluating something in a way that they can be manipulated and tricked, something that happened with Wirecard in Europe, which was a big scandal because Wirecard was a leading payments provider, but they were able to manipulate their relationship with their auditor. So that's a good example of a failure mode for auditing. If you had a bunch of APIs and Oracle networks verifying what was in the APIs, as in what is the status of the underlying cash holding, what is the status of the underlying gold, what is the status of the underlying real estate for tokenized real estate, what is the status of whatever underlying asset for really whatever tokenized asset, then you're getting a real-time audit. And in the world of fraud, there is something known as the gap. The gap is the period within which you can conduct fraud. And the gap on an annual person-based audit is a year or a quarter. And the gap on proof of reserves for reserves is a few seconds, or however quickly we can get it into a block, depending on the chain. For proof of composition, it's not just that the assets exist, but it's the composition of the assets. So for example, with Silicon Valley Bank, it was understood that they had treasuries, but it wasn't understood what vintage of treasuries or what the yield on those treasuries was. And that's what proof of composition would solve, is it would give you more fidelity, more clarity on what the treasury composition is. And that could allow you to avoid a bank run like Silicon Valley Bank. And then you have proof of solvency. Proof of solvency is an even deeper level of depth about an underlying counterparty that you're relying on to properly service your stablecoin or to properly service your tokenized real world asset or fund or whatever it is they're making for you. And that's kind of, I would say, the current leading edge and pinnacle. And Chainlink is the largest provider of proof of reserves globally to the most stable coins, commodity coins, various tokenized assets. We're starting to now provide proof of composition, and proof of solvency is something we're working on and hoping to provide soon once we can fully interconnect Chainlink into all the necessary data points and connections that can prove solvency. But what you're really doing is you're massively reducing counterparty risk, because the gap in which you can conduct fraud or misinform the market is condensed from years or quarters or months down to seconds, which is a very fundamental change for how the financial system and counterparty risk can work, which I think regulators will actually demand and mandate.
And you're not just talking about lowering counterparty risk, you're talking about it sounds like a potentially drastic reduction in the number of auditors that are needed to do all this. Perhaps a drastic reduction in the amount of compliance officers that are needed for all of this. What does proof of reserve do for the barrier to entry in these industries? Like, are we going to see where it's easier for startups to start building competitors with banks? Is all of this automation of auditing and regulatory compliance going to change the dynamic in that competitive market?
Yeah, so there's two things there. The first one is the automation of compliance, which auditing and proving reserves and proving the composition of your reserves and proving solvency are a part of. But there's other parts to compliance, like AML KYC compliance, accredited investor compliance, OFAC check compliance, all kinds of compliance. Generally speaking, the cost of doing compliance is one of the big barrier to entries for new banks. And that is because the compliance rules are generally pretty vague and they're not clearly defined in technical terms. So I can't technically tell you exactly the standard you need to meet to comply with AML KYC requirements or accredited investor requirements. How can I technically prove that? This is actually what we're working on with many regulators now, is how do we automate compliance, not just about reserves, not just about identity, but actually all aspects of compliance. And if we're able to automate the process of compliance, whether that process is reserve related or AML KYC related or other aspects of compliance that are costly and complex and are, by the way, done very poorly in some cases, leading to huge tens of billions of dollars in fines. So the current compliance system doesn't really work. And the current system of auditing to make sure that counterparties are secure and reliable doesn't really work. Otherwise, you wouldn't have a Bernie Madoff, you wouldn't have a Wirecard, you wouldn't have, more and more of these problems, because it is gameable. The technical version of all this is less gameable, it's more efficient, and it can be proven to the market and regulators on a real-time, low-cost basis. So they can all just verify. They don't need to wait 6 months or a year to receive the audit. They can get a real-time audit so that everyone can know exactly what's going on inside of their counterparty in the way that it relates to their risk as fast as the counterparty knows it. And so the counterparty's capacity to take risk is very low. And then the barrier to entry that this lowers for new entrants is very significant. And this is, in fact, what I think will happen fundamentally from our industry's point of view, is it will generate a lot of fintechs, a lot of digital banks, and it'll generate a few large winner commercial leading global banks that reach a new level of efficiency and are able to do two things because of that. One, they're massively able to compete on lower costs. And two, they're able to provide much better financial products that were previously inaccessible to anybody but the most wealthy family office and institutional pension investor. And so the infrastructure cost of running a fintech or a digital asset bank or a digital bank is something that I think our industry will indeed depress. And that'll create very much needed and very positive global competition and innovation so that the process of capitalism can kind of take the asset management and the global banking industry to a new level of value creation and innovation.
So as we're wrapping up here, I do want to bring it back to an earlier question that I started to ask, and bring it back home here to Europe. I do think that the US dollar has kind of become synonymous with stablecoins. And I think there's a degree of continent pride and maybe even French pride to see Société Générale getting out there with a euro-backed stablecoin. I think there were some early experiments with euro-backed stablecoins that didn't really take off, and the dollar kind of just became synonymous. Do you think that the sort of relative reliability of the Federal Reserve is going to lead to a sort of permanent moat with US-backed or with dollar-backed stablecoins, or is there a place for euro stablecoins and other currency stablecoins?
I mean, I guess there's two things here. First thing I would say is sovereign currencies are reaching levels of debt to GDP that are simply unrealistic and unsustainable. They're levels that were reached only during world wars, and then there needed to be a reset period. I think we're approaching such a reset period, so if you look at any reasonable economist, I think they'll tell you buy Bitcoin, buy gold. That's the first thing I would say. The second thing I would say is that the places that allow tokenization to flourish will be the places that create the most digital assets. And so the US has a very big advantage because everybody wants the dollar as a method of transaction settlement. Everybody wants high quality US issued assets, but they need to catch up on their ability to generate those assets in the US. If the quality of the US assets is still seen globally at that level of quality, and the US catches up in the sense that they can tokenize those assets, then the US can maintain the level of market share that it currently has in the global financial system. If conversely, those assets don't get tokenized and the highest quality asset is a Europe issued asset or a Dubai issued asset or a Singapore issued asset or a Hong Kong issued asset, then that asset will naturally start getting adopted in this growing Web3 financial system. So this is where governments can make a significant impact on their economies and their region's economic growth by enabling their domestic banks, their domestic fintechs to reliably tokenize, create digital assets, but not just about stablecoins, about tokenized funds, tokenized real estate, tokenized everything. And this is really the race that is now underway. Yeah. The US, because of its position in the global financial system, is fundamentally in a good position to win that race because people still want assets from the US financial institution market system, the financial system from there. But if somebody else generates equally high quality or better quality assets sooner, then the Web3 economy will start adopting those assets. And it's the same for Europe. So I think the thing with Europe is I wouldn't be conservative and consider all the little problems that could happen. I would get in the race and I would start issuing tokenized funds. I would start making sure domestic banks are issuing many stable coins. I would make sure that transactional settlement is using those stable coins, is using those tokenized funds as collateral for 27/365 collateral management. The time to do this is now. The race is on. And with more regulatory clarity from the US, it's gonna accelerate not only the US, but it's gonna accelerate all other markets that view the US as a super regulator that they take certain regulatory signals and guidance from because they want to be compatible with the US regulatory system. So
Sergey, sorry to interrupt. I've got a couple minutes here. You've mentioned a couple larger regulatory jurisdictions, more influential. There is also a race on the developing side. There are countries with relatively tiny GDPs that are also in the hunt to get their piece of the future, to create regulatory welcome regimes for stablecoins. What does this race look like? Or what does it feel like? Is there a sense of urgency here? Are we looking at something where the winner of the stablecoin race is going to be determined in 6 months and be the global dominant currency for the next 100 years? Or is it something where it's going to play out over the next decade or so?
I think it's the next decade. I think stablecoins are essentially a technical wrapper for currencies. If fiat currencies have a moment of weakness or even collapse, then you should notice that they're not named fiat coins. They're called stable coins. So the fundamental premise of stable coins is to provide a stable form of currency, which right now is dollar-backed because of the dollar's global position as a stable form of currency, which is kind of the dynamic that's been happening for many years, and if it continues, will allow the global financial system to grow and succeed. If, however, there is some kind of big blow-up, and we are indeed in some kind of sovereign debt, sovereign currency bubble, then I would think that stable coins remain focused on stability in terms of the currency they provide. And then that starts to look like more of a basket of currencies, or a basket of currencies and hard assets, or a basket of currencies, hard assets, and algorithmically determined equities, or a basket of all of that plus something else. So the fundamental premise of stablecoins from the Web3 community and all the people building stablecoins now for over over a decade, pretty much, is that concept of stable. So I wouldn't confuse fiat currency coins with stable coins. It's just the early version of stable coins is fiat currency coins. And if the dollar remains the dominant transaction settlement method, then I think you'll just have stable coins be US dollar coins, as they have been for a long time now, even though the US has been negative on stable coins for a long time. And if that continues, then the vast majority of stablecoin pairs on exchanges will be USD based, and
it's
then
not
you
just
will have
a technology issue. If you really want to have a competing stablecoin, you just have to have a more responsible central bank.
I mean, there's all kinds of ways you compete on stablecoins now. There's yield sharing. I'm more than sure that many stablecoins are going to start providing their own yield on top of the yield sharing, because the stablecoin has now turned into almost a bank account, a savings account replacement if it does yield sharing. But the stablecoin also exists on a spectrum of other things that aren't called stablecoins, but also behave like a savings account. For example, tokenized treasuries. Tokenized treasuries, many people that make those want to see them use this currency, and they also give you yield. Tokenized money market funds, many of the people that make those want to see them used as currencies and have people get their wages paid in tokenized money market funds, and they give you yield. So I think there's going to be an intense period of competition that is going to fundamentally benefit the consumer, because the consumer is suddenly going to go from bank accounts that give them 1% to 2% when the local interest rate is 4 or 5% to yield sharing stablecoins that give them 8%, even though the local interest rate is 4 or 5%, because the stablecoins are in such intense competition with each other that they wanna shoot out and win. So I think there will be massive stablecoin competition. There will be massive incentives for people to use different stablecoins, and the regulatory environments that allow the most creative but still safe stablecoin schemes to operate in their ecosystem will be the countries and the stablecoin ecosystems that generally get more market share. And then the important nuance there is that you can now technically guarantee that the asset, in this case the stablecoin, is reliable through things like proof of reserves. So you don't have to just rely on people.
That is a great note to end on. Thank you so much, Sergey. Making financial infrastructure always interesting. Please give Sergey a big round of applause. Looking forward to the next conversation about treasuries.
Thank you.